Okay. Ariane, do you know what happened today?
Yeah.
One of the headline in the news today was that Reserve Bank, who controls the interest rate in Australia, put hold on the interest rate. So for the second time in a row, we saw Reserve Bank not increasing the interest rate. So it is good for property owners, people who got mortgage, bought a house and they've got a big mortgage to pay, and I'm really happy for them. But yeah,
My Pepsi.
yeah, sure, yeah. But in property development, as a business, we don't really care about interest much. Yeah. Well, we do care about the interest because the cost of a project, obviously, the interest rate that we pay is the cost of a business. So obviously, the less cost, the more profit we make. But in a property development environment, can I have some of your Pepsi? Nice. Thank you. That's refreshing. Yeah, in a property development environment, so the loan that we get, we sort of more look towards the condition of a loan rather than, the interest rate. We've been time that I have paid, 18, 19, 20% interest rate, but it was for a short period of time. And as I said, there's a cost of business. So we've built it into the project feasibility. But to understand how we at OwnerDeveloper structure most of our projects from a finance point of view, you first need to understand how the bank loan to you. Yeah, correct? So either you can borrow money from many different sources, such as the big banks, the commercial lenders, private investors, mezzanine finance. There's a very big subject to talk about. But generally, there are two phases to a project finance. One is at the very early days, at the acquisition stage, when you purchase a land or purchase a property, and then the construction loan, which is the second part to that finance. And usually, financiers or bank only lend you a certain percentage of a project. They call it a loan to value ratio. And in a residential loan, mortgages, that's about 20%. So 20% deposit to purchase an 80% equity to purchase a property. But in commercial loan, you can actually get a higher, in a commercial environment, you get a lower percentage, but you pay a bit of a higher sort of an interest rate. But the beauty of it is, Ariane, you're listening? The beauty of it is you usually in a commercial loan environment, you pay that interest at the end. They call it the capitalized interest. So again, you work that interest holding cost, work it out how much it is, and you built it into your feasibility, so it become your project cost. A lot of the time, what we do, we engage private investors to at the acquisition stage, so we can provide a first mortgage kind of security, and that what that does, that keep equity within the deal. So getting that finance, construction finance later down the track is a lot easier. Does that make sense?
Yeah.
So the whole development finance scenario, there are many different ways of doing it. I only touched on one that we often use, but is a very long subject to talk about. But yeah, the long story short, in a property development as a business model, we don't really care much about the interest rate going up or down. Realistically, whatever that interest rate is a cost of business and is a deal put together in a profitable, I guess, manner, it doesn't really matter. Yeah? We forgot to introduce ourselves, Aryan. My name is Adam from OwnerDeveloper. This is Aryan. We've just done another development drive to success. We like doing these videos and hoping our fellow developers get something out of it. In property, of course. So until next time, happy developing, everyone.
Have a good day.
And have a good day. Cut, Mr. Director. You gotta do the cut.